Ladies and gentlemen, good day and welcome to Q4 FY2026 earnings conference call of SMC Global Securities Limited, hosted by XB4 Advisory. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gautam Kothari from XB4 Advisory. Thank you, and over to Mr. Kothari.
Good evening, everyone, and thank you for joining us on the Q4 and FY26 earnings conference call. Joining us today on the call are Mr. Subhash Chand Agarwal, Chairman and Managing Director of SMC Group, Mr. Mahesh C. Gupta, Vice Chairman and Managing Director of SMC Group, Dr. D.K. Agarwal, Chairman and Director, SMC Capitals Limited, Mr. Ajay Garg, Director and CEO, SMC Global Securities Limited, Mr. Anurag Bansal, Whole-Time Director, SMC Global Securities, Mr. Himanshu Gupta, Director and CEO, Moneywise Financial Services Private Limited, Ms. Shruti Agarwal, Whole-Time Director of SMC Global Securities Limited, Mr. Pranay Agarwal, Director of and CEO of Stockscard, and Mr. Vinod Kumar Jhamar, President and Group CFO. Before we begin, please note that today's discussion may include forward-looking statements which reflect the company's current views and expectations. These statements are subject to risk and uncertainty, and actual results may differ materially. A detailed safe harbor statement is provided on the second last page of our earnings presentation, which is available on the stock exchange and the company's website as well. With that, I now invite Subhash sir to share his opening remarks. Over to you, sir.
Good evening, everyone, and a warm welcome to all participants on this call. We hope you have had the opportunity to review our quarter 4 and full year financial year 26 financial results and the accompanying earning presentation, both of which are available on the stock exchange and on our website. Before we move into our financial performance, let me first outline the prevailing industry dynamics and the key developments that shaped the operating environment during the period. Starting with the broking industry, financial year 26 was a year of transition. The cumulative impact of regulatory measures introduced over the last several quarters, the higher STT on F&O, the phased implementation of true-to-label charges, and the F&O participation framework continue to play through industry derivative volumes during the year. This period has required a strategic recalibration toward cash, delivery, distribution, and advisory-led businesses, which we believe is a healthy structure shift for the industry. The fourth quarter, in particular, saw heightened market volatility. Equity market witnessed a sharp correction in March 2026 against a backdrop of global trade-related uncertainty and geopolitical events. The industry also experienced a technical disruption at the market infrastructure level during the quarter, which temporarily affected trading activity. Despite these headwinds, retail participation, SIP flows, and the broader investor base in India continue to expand structurally, reinforcing the long-term opportunity in our markets. On the regulatory front, the operating environment is moving in a constructive direction. During the quarter, SEBI issued 2 notable circulars aimed at ease of doing business for stockbrokers, a revised technical glitch framework which rationalizes reporting requirements and exempts smaller size brokers, and other circular simplifying bank and demat account reporting obligations effective from April 17, 2026. These developments, together with RBI recent directions on bank exposure to capital market intermediaries, are reshaping the funding and compliance landscape for the industry. We believe diversified, well-capitalized intermediaries with strong performance and strong compliance frameworks are best placed in this evolving environment. Thanks to the insurance broking industry, the sector continued to demonstrate strong broad-based momentum during FY26. Industry growth was supported by improving insurance penetration, rising customer awareness, sustained demand for retail products, protection and health products, and a continued shift towards advisory-led digitally enabled distribution. The IDA's ongoing push towards composite intermediation has further widened the addressable opportunity for established intermediary. With respect to the financing and NBFC segment, the operating environment during FY26 was the most challenging of the three. The sector navigated moderate credit growth, tighter underwriting standards, and heightened focus on asset quality. Funding costs stayed elevated through much of the year, and unsecured personal lending and microfinance segments in particular saw industry-wide caution and elevated delinquencies, with normalization only beginning to emerge in the fourth quarter. As a result, most participants, ourselves included, deliberately calibrated disbursements and prioritized secured lending segments, while policy and liquidity measures during the latter part of financial year 26 aim to these conditions. That benefits will translate gradually into balance sheet expenses. On the broader regulatory side, the labor code that came into effect during FY26 created a more uniform compliance framework across industries, with an associated impact on employee-related line items during the implementation phase. We had operationalized the necessary changes in advance, and the transition has been smooth across our group entities, with cost normalization now complete. Let me now walk you through the key highlights of our performance for the quarter and the full year. In Q4 financial year 26, our consolidated operational income stood at rupees 516.9 crore, representing a YOY growth of 22.6% and a sequential growth of 4.5%. EBITDA for the quarter was rupees 89.7 crore, up 42.6 YOY, with an EBITDA margin of 17.4% and expansion of 250 basis points on a YOY basis. PAT stood at rupees 21.5 crore compared to rupees 4.1 crore in Q4 FY25. Sequential moderation in EBITDA reflects the impact of market volatility in March and the typical seasonality in our businesses. But the strong YOY recovery in quarter 4 reflects the operating leverage in our broking and insurance businesses, alongside meaningful improvement at the segment EBIT level across all the three operating segments. For the full year, FY26 consolidated operational income grew 5.7% to rupees 1,876.9 crores. EBITDA for the year was rupees 376.4 crores, with a margin of 20.1%, while PAT stood at rupees 103.2 crores. We want to be transparent with our investors that FY26 saw margin compression at the consolidated level on a full year basis. This was driven primarily by two factors. First, sustained funding costs at the consolidated level, with finance costs rising, and second, the deliberate calibration in our financing business, which I will speak to in more detail in a moment. Our fees-based businesses, broking, distribution, and insurance continue to provide stability and growth and help offset a meaningful part of this pressure. Within our broking, distribution, trading businesses, FY26 was a year of continued expansion in client engagement, geographic reach, and digital adoption. Even against the backdrop of a moderated derivative volume environment, segment revenue grew 4.3% on YOY basis to 1089.2 crore, while Q4 FY26 revenue rose 19.3% YOY to rupees 286.8 crores, with segment EBIT improving sharply by 66.6% YOY to 60.9 crore in the quarter. Our broking client base, including stock card, grew to 30.39 lakhs accounts as of FY26, while our broking DP AUA expanded 23.7% 96% to rupees 1,42,703 crores. Our distribution business continued to scale with cumulative mutual fund AUM reaching to rupees 4294 crore, supported by 94,392 active SIPs. Online penetration on our broking client base reached 72% in FY26, up from 61% a year ago, reflecting the success of our continued investment in digital platforms, in-house trading applications, and AI-led customer engagement tools. Like the broader industry, we have continued to deepen our presence in cash delivery, distribution, advisory areas that we believe are the structural growth drivers of this business going forward. Our financing business operated through 38 branches across 7 states with a continued focus on asset quality, portfolio diversification, and calibrated approach to growth in a challenging macro environment. Let me address the key data points directly. NBFC AUM stood at rupees 1,119 crore as of March 2026, down from 1,291 crore a year ago. And disbursements during FY26 were 720.05 crore, materially lower than financial year 25, reflecting our deliberate decision to slow originations in segments where we observed early stage stress. A stance that has been broadly consistent across the industry, particularly in the secured and micro finance linked segment. This was a conscious choice, not a constraint. The outcomes of this discipline are visible in the portfolio quality. Secured AUM at 76.71%, GNPA at 3%, NNP at 2%, collection efficiency of 98.63%, and a healthy capital adequacy ratio of 43.2%, the strongest in 4 years. Net worth stood at rupees 488.3 crore with a ROA of 2.08%. The lending portfolio remains well diversified across SME WCTL, SME LAP, onward lending, SME assets, micro LAP, gold loans, capital market funding, and supply chain financing. With sector level normalizations now beginning to emerge in stress segments, we expect to return to a more measured growth posture in this business as macro and credit conditions stabilize. In our insurance broking business, growth momentum was particularly strong during the year and tracked the broader industry tailwind. Segment revenue grew 17.1% year on year to rupees 667.5 crore in FY26, while Q4 FY26 revenue rose 29.8% YOY to rupees 208.1 crore. Gross premium for the year stood at rupees 3,145 crores, with the business issuing 11.39 lakhs policies, supported by a workforce of 503 employees, 16,600 post agents against 393 motor insurance service providers. A key strategic development during the year was the upgrade of our category from direct broker to composite broker, which now allow us to expand into the reinsurance segment as well, opening up a meaningful new growth revenue going forward. We do want to flag that segment EBIT growth of 4.8% trade revenue growth, reflecting investment in distribution capacity and technology that will support the composite broker expansion. Overall, while FY26 presented a more measured operating environment than FY25, particularly in our financing business and through periods of market volatility in the second half of the year. Our diversified business model, strong national distribution network of 203 branches across 396 cities, and continued investment in technology and risk management have allowed us to deliver healthy operating outcomes in our fee-based businesses while protecting balance sheet quality in our financing business. We believe this position the group well for sustainable long-term value creation as the operating environment normalizes. With that, I now hand over to Mr. Vinod Kumar Jamar, our President and Group CFO, to take you through a more detailed overview of our financial performance. Over to you, Vinod.
Thank you, Subhash sir, and good evening to everyone on the call. I will now take you through financial and operational performance for Q4 FY26 and the full year FY26 on a consolidated basis. For the quarter ended March 26, our consolidated operational income stood at rupees 516.9 crores, representing YOY growth of 22.6% and sequential growth of 4.5%. EBITDA for the quarter was rupees 89.7 crores, up 42.4% YOY, with an EBITDA margin of 17.4%, an expansion of 250 basis points on a YOY basis. Profit after tax came at rupees 21.5 crores as against 4.1 crores in Q4 FY25, with PAT margin improving by 320 basis points to 4.2% sequentially. EBITDA and PAT moderated, primarily reflecting the sharp market correction in March. Normalization in broking activity after a strong Q3 and timing of certain expenses. For the full year FY26, consolidated operational income grew 5.7% to rupees 1,876.9 crores. EBITDA stood at rupees 376.4 crores with a margin of 20.1%, while profit after tax was rupees 103.2 crores. As Subhash sir mentioned, EBITDA was lower by 10.3% and PAT lower by 29.9% on a full year basis. The two principal drivers of this margin compression were higher consolidated finance cost of rupees 221.3 crores and the calibrated approach in our financing segment and reduction in net gain on fair value changes in. On the EPS line, I want to note that basic and diluted EPS for FY26 was rupees 4.87 versus rupees 13.92 reported in FY25. This comparison is not strictly like for like, as our paid-up share capital increased from 20.9 crore to 41.9 crores during the year on account of corporate actions on equity, and the FY26 EPS is calculated on the enlarged capital base. On a standalone basis, Q4 FY26 operational income stood at rupees 249.9 crores, up by 25.6% year on year, with EBITDA of rupees 65.8 crores at a margin of 26.3%, an expansion of 890 basis points year on year basis. Standalone PAT for the quarter was rupees 20.7 crores, up 141.1% YOY. For the full year FY26, standalone operational income grew 4.7% to rupees 968.1 crores, with EBITDA of rupees 251.4 crores at a margin of 26.0% and PAT of rupees 81.3 crores. Turning to segment-wise performance, in the broking, distribution and trading segment, Q4 FY26 revenue grew 19.3% YOY to rupees 286.8 crores, with segment EBIT rising sharply by 66.6% YOY to rupees 60.9 crores. For the full year, segment revenue grew 4.3% to rupees 1,089.2 crores, while segment EBIT was rupees 239.4 crores, marginally lower by 3% YOY basis. The relatively modest revenue growth at the full year level reflects the moderated industry derivatives volume backdrop and the heightened market volatility in the fourth quarter, while the strong Q4 EBIT improvement reflects operating leverage and improved cost efficiency as we exited the year. In the insurance broking segment, Q4 FY26 revenue grew 29.8% YOY to rupees 208.1 crores, with segment EBIT of rupees 4.5 crores, up 6.7% year on year. For the full year, segment revenue grew 17.1% to rupees 667.5 crores, with segment EBIT of rupees 14.3 crores, up 4.8% year on year. The robust top-line growth reflects the strength of our distribution platform, our expanding POS and MISP network, the structural industry tailwinds. The slower EBIT growth versus revenue reflects investment in distribution capacity and technology infrastructure to support the upcoming reinsurance opportunity following our composite broker upgrade. In the financing NBFC segment, Q4 FY26 stood at rupees 43.3 crores, up 6% YOY with segment EBIT of rupees 21.2 crores, up 18.6% year-on-year, a healthy quarterly outcome. However, on a full year basis, segment revenue declined 15.1% to rupees 188.9 crores. Segment EBIT declined to 26.2% to rupees 102.2 crores and PAT moderated to rupees 24.6 crores from rupees 46.3 crores in FY25. As Subhash sir explained, this performance is the direct outcome of a deliberate decision to calibrate disbursement in challenging macro environment where we prioritize our asset quality protection over AUM growth. The supporting metrics validate that decision. Secured AUM at 76.71%, CRAR at 43.2%, up from 37% in FY25. Collection efficiency at 98.60%, NNP at 1.99% and credit cost at 1.3% of average net receivables. NIM moderated to 7.3% from 8.2% in FY25, reflecting the elevated funding cost environment that affected the wider NBFC sector during the year. On the borrowing side, our NBFC continues to maintain a well-diversified borrowing mix with bank borrowings forming 85% of the mix in FY26, up from 79% in FY25. Our borrowing program is supported by ICRA A- stable rating on the long-term bank loans and KR A- stable and IVR A stable rating on our NCD program. While the recent RBI directions on bank exposure to capital market intermediaries have led parts of the industry to diversify funding sources further, our existing diversified mix and conservative leverage of 1.52x at the NBFC level position us well to navigate the evolving framework. At the consolidated level, our debt-to-equity ratio stood at 1.53x with consolidated net worth of rupees 1,304 crores. Overall, our performance for Q4 and FY26 reflects three things. First, strong recovery in Q4 across all operating segments despite a volatile market backdrop. Second, healthy full-year growth on our fee-based businesses, supported by structural industry tailwinds in distribution and insurance. And third, a deliberate, transparent moderation in our financing business that has preserved balance sheet quality and positions us well for the next leg of growth. We remain focused on financial discipline, cost optimization, scaling our digital and technology platforms, and progressively rebuilding return metrics as we move into FY27. With this, we conclude our remarks and the floor is open for questions and answers. Thank you.
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask the question. The first question is from the line of Manohar Rajput from Lexus Financial Service. Please go ahead.
Hello, sir. I'm audible?
Yes, go ahead.
I wanted to know, in our broking business, can you give up a breakup of our cash segment and commodity and option segments? And also, I wanted to, for this quarter or for the whole FY26, have we seen a spike in our commodity segment of broking?
Yeah. Hi, Manoj. This is Ajay Gar, Director and CEO. So, the last year, equity cash market, the brokerage share was around 50%. Future option was around 40%, and commodity was 10%. So we have seen like earlier the commodity ratio was around 4 to 5%. Now it has grown up to 10%. And even in future, we foresee a good growth into commodity business.
Okay, sir. Any number you are expecting going forward that this will be 20% or 30%?
It should gradually, because worldwide commodity business is much larger even as compared to equity business. And even our regulator is very proactively wants that commodity segment should grow. And we have seen even in budget, there is no change in CTT as compared to STT. So, and new products are continuously being launched, like electricity contract has recently been launched, and we are foreseeing even the weather contract might also be launched. So, and retail participation is also increasing day by day. So, we are seeing good traction, and gradually this percentage should keep on increasing.
Okay. And sir, on the NBFC side, this year I think our disbursement was very less compared to other years. So what I have seen in the presentation is that our onward lending is constant and SME products are lower. So are you focusing more on lower yield secured products, or it will be the similar as over the past years, or this year was an exception?
Yes, hi, I am Himanshu Gupta, Director and CEO of Finance. So you rightly observed that the on-lending products disbursement have been constant over the year. However, there is a recalibration within our other product, as Subhaji and Jamarji briefly highlighted over their speech. So let me go deep down further into that SME lending breakup. So within the SME lending, we have increased our focus on certain products while, consciously reducing exposures on others. For example, the LAP product, which is a larger ticket size product, therein we have actually discontinued fresh disbursement. So, FY25, the disbursement was 70 crores as against, very marginal disbursement during this year. And similarly, for the unsecured business loans, FY25 disbursement was 281 crore, and this is 93 crores during this completed financial year. So these two products, we have consciously, reduced our exposures, while, our focus remains on other small ticket size secured products like micro LAP and, gold loan and asset finance. Therein, we have been increasing our disbursement. So if you, compare the disbursement after excluding LAP and unsecured business loan, actually the disbursement numbers have grown from 452 crores to 614 crores, which shows, the growth coming from our focused product lines. And, this year the AUM got offset due to, reduction in the couple of these products. But going forward, we expect, the disbursements from these new product lines or focused product line would be much higher, and there would be increase in the AUM.
Okay. Any specific number of you are expecting that this will increase for the next year? Keeping aside the unsecured loan.
You are asking about which number?
For our AUM disbursement for the next year. Anything you are...
AUM we expect to grow at around 15 to 20% during the year.
Okay, got it. And sir, I have a last question on the insurance side. So, what initiatives are underway to deepen insurance cross-sell, as we have seen our insurance business is continuously growing? And what is the upside opportunity in terms of policies per customer over the medium term?
Hi,
Manohar. Hi, Manohar. This is Sakshi, CFO at SMC Insurance. Thank you for your question. So, as far as insurance cross-sell is concerned, yes, we are looking forward for opportunities for cross-sell to include the group financials leverage to expand our insurance. Yeah.
And ma'am, what will be the upside opportunities in terms over the medium term?
So upside, basically we would be looking at our reinsurance segment as well. to basically use the group corporate clients as well.
Okay.
Yeah.
Got it. Thank you. That's it from me. I'll join back.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Tejpal Singh from Spark Capital Advisors. Please go ahead.
Hello, am I audible, sir? Hello.
You are audible.
Okay, so my first question on the stock cards performance, FY26 performance. So could you provide comprehensive update on StockX cards FY26 performance, including active client, gross client addition, and revenue and current blended ARPU?
Yes. Hi, this is Pranay Agrawal, CEO of StockCards. So I'm very happy to inform that this year we managed to go acquire the market share in a big way. We opened 100,000 clients during the year, and even when you see the NSE data, we are placed on 4th number in terms of contribution to NSE in terms of active clients. So we are in the rank, we are 4th in the year 2025-26. And also, as you asked about the growth in terms of revenue and all, we have grown 150% in terms of revenue alone. So currently this year has been really good for us, and in going forward also we expect it to be we expect it to contribute to the group in a big level.
Okay, great to hear, sir. And sir, my second question on the NBFC side. So what is the strategic intent behind diversifying toward NCD, sir? So we are moving towards the NCD. So how do you see expect further NCD issuance in the next financial year?
I think you were talking about the borrowing, source of borrowing, and
yes.
diversification. Just to clarify, both NBFC as well as broking entity have raised fresh borrowing to NCDs. Okay, so this year NBFC raised around 25 crores of fresh NCD, while the broking entity raised about 150 crores of fresh NCDs. So
okay.
Diversification of borrowing and reduce reliance on the bank borrowing, and this is also in line with the RBI's intent, wherein they want corporates to reduce their dependency on bank borrowing.
Okay. And sir, one last question is that how well we are able to cross-sell our insurance product to our existing demat account holders. So we have a large distributor and active NBFC holder, so just wanted to know.
Actually, like broking, we do have a large client base, so cross-sell is always on the top of the mind. So we have integrated even the insurance and mutual fund capability into our mobile app as well. And we are doing cross-sell
mobile app across
B2C and B2C network. So we are generating a lot of point of sale costs through of insurance as well through a broking network. So last, I think more than 8 crore of premium we have done from broking as far as insurance is concerned, but gradually this has been completely offline. So now we are focusing on even online cross-sell penetration. So we are integrating more deeply into our mobile app and would start digitally promoting it as well. So in time to come, the focus in cross-sell would keep on increasing, and we foresee a good numbers into this.
Okay, great to hear, sir, and all the best for your future performance.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Mahesh Kumar from MU Investments. Please go ahead.
Hello, am I audible?
Yes, sir, go ahead.
Yeah. So thanks for the opportunity. I just had a couple of questions. So I just wanted to ask about NBFC business in FY26 has moderated with AUM revenue and EBIT, declining. So could you outline the key drivers, whether it is cautious underwriting, sectoral stress, portfolio rundown, or demand slowdown? Also, what's your roadmap for lending business over the next few years in terms of AUM growth and target product mix?
Okay. So, Himanshu Gupta, Director and CEO of SMC Finance. So, I'll reiterate our, business strategy has been to increase the secured book. So, as you will see over the years, our secured AUM has been increasing, and as we ended March 26, secured AUM stood at about 75%. And that has been a conscious, decision wherein we tightened the underwriting for unsecured loans. And under the unsecured loans, apart from tightening, we have discontinued surrogate programs wherein we observed there was a higher delinquency. And within the secured product lines also, we have consciously been focusing more on the smaller ticket size loans wherein there is a, larger diversification, and also we get higher yields. So with this approach, we have been working since about last couple of years. So the net effect has been that there is a rub-off on the AUM, wherein the unsecured product exposures have been reducing, and large ticket exposures have also been reducing. And we have been building secured retail book. So over the last couple of years, you won't see any growth in the AUM, but when you see the product mix, there has been achievement in line with our target segments. And going forward, I think there would be another year where we would have certain amount of rub-off and slight growth in AUM. This year, as I said, we are targeting 15 to 20% growth in AUM. And I think from the next year, FY28-29, once the older products reduce to a larger extent, then we would see good growth from the new product lines.
Okay, sir. Okay. So, and sir, in the insurance broking business, so our revenue largely skewed towards the general insurance product. So do you see this continuing as a main growth driver? In which segment are you seeing the most driving the growth?
Hi, this is Sakshi, CFO SMC Insurance. So yes, it's true. So basically, 90% of our revenue is from the general insurance, and that will continue to remain a major contributor to our revenue. Though we foresee a growth in life insurance revenue as well in the coming years.
Sure, ma'am. Sure. And lastly, I just wanted to, if I could just squeeze in one question. With the recent RBI, circular restricting leverage for, NBFC and group entities in proprietary trading, what impact do you expect in SMC Global's, proprietary trading P&L, given its historical strong contribution from arbitrage and, HFT type of trading?
This is Dr. D.K. Agarwal, CMD SMC Capital. Just to clarify that arbitrage operations, the proprietary arbitrage operations are kind of treasury operations. So whatever surplus funds are there in the company, at any point of time, we deploy that fund into arbitrage. So we have checked and we are sure that whatever funds are required for our current level of arbitrage, those funds are available with us as we are sufficiently capitalized.
Okay.
So there would be minimal impact, or rather very negligible impact, or maybe no impact on our operations.
Okay. Thank you so much. That's it from my side, and best of luck.
Thank you.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Vikrant Sahu from RK Advisory. Please go ahead. Vikrant, may I request you to unmute your line and proceed with your question, please? Due to no response, we move on to the next participant. Next question is from the line of Aman Singh, individual investor. Please go ahead.
Yeah, hello. Sir, can you hear me?
Yeah, we can hear you. Please.
So, sir, I had a couple of questions. So, first one was, could you share the current monthly SIP flow being sourced to SIP, the size, the live SIP book, and how it has trended over the recent quarter? SIP.
You are talking about SIP?
Yeah.
Your voice was not clear. Can you repeat it again?
Yes, SIP. Could you share the current monthly SIP flow being sourced to SMC and the size of the SIP book and the recent trend?
Anurag, you can take.
Yeah, hi, Anurag here. So on a monthly basis, we are, sourcing around 1,900 to 2,000 SIP. Current SIP, live SIPs are 94,392, with an average of rupees 2,722 per SIP, contributing around 25.69 crores per month.
Okay. So my second question was that with GNPA having versus the prior year, and it is still elevated compared to FY24, where that specific operational or regulatory constraints in the SME segment, or is the company deliberately rotating capital, towards micro, LAP, or gold loans?
Yeah. So, regarding the GNPA, as you rightly observed, this is, almost at same level as compared to last year. Slightly better in fact, but if you compare with FY24, it is slightly higher. So basically, there are certain large secured accounts which are classified as GNPA, and we have sufficient security available with us for the recoveries. However, the legal process or the settlement process is taking some time. We are, actively pursuing the matters and taken adequate legal measures, as well as, are in touch with the customer for the recoveries. So we expect the good amount of recoveries from these large secured exposures, and we have made adequate provisions also.
Okay, and so additionally, on the annual disbursement side, which have collapsed versus the previous 2 years, so what quarterly disbursement run rate should we assume going forward, and what will be the key trigger or return to growth?
So, overall, you will find that the disbursement numbers have gone slightly down over last year and couple of years. However, if you go one level deeper into the product-wise disbursement, so as I told you that we have tightened the underwriting of secured product. So it is coming from that tightening. Disbursement of unsecured product has been consciously reduced, which was 281 crore last year. Now it is 93 crores. So this was our conscious decision. And discontinuing large ticket LAP, it was 225 in FY24 versus 70 crores in FY25 and almost negligible in current year. So these two are the product wherein there has been steady decline in the disbursement figure. However, if you look at all other products apart from these two, so in FY24 we disbursed 315 crores, and compared to that FY25 450 crores and FY26 615 crores. And this year we expect growth in the disbursement from this 614 crores. We expect it to go above 800 crores.
Okay. Okay, sir. So last question. So what can the segment, insurance broking segment, sustain a strong double-digit growth trajectory over the next year, given the competitive intensity from large digital aggregators?
Hi, this is Sakshi. Yes, so given the current scenario, so we expect basically a 15% growth over the next financial year as well. Given our reinsurance segment, that will also be a contributor to our revenue. And because we are focusing on both physical and digital selling, so we shall try to achieve the targeted numbers.
Okay. Thank you so much for taking my questions and good luck.
Thank you very much. Ladies and gentlemen, that was the last question. I'll now hand the conference over to Mahesh C. Gupta for closing comments.
Myself, Mahesh C. Gupta. Thank you for joining us today. We trust this session has helped address your questions and provide clarity on our performance for the quarter and the full year. For any additional information or follow-ups, please feel free to reach out to our Investor Relations partners at XB4 Advisory. We appreciate your continued engagement and look forward to connecting with you again in the next quarter. So thank you very much.
Thank you very much. On behalf of XB4 Advisory, that concludes this conference. Thank you for joining us, and you may now disconnect your line. Thank you.